Delta Airline paid the highest fuel bill in the company's entire history. Fuel cost jumped 75% from a year earlier, the single biggest cost line on the whole airline, up three quarters in 12 months. And here is the part that doesn't fit the headline. Delta still beat its own profit guidance. So, how does an airline post record fuel costs and beat expectation in the same breath? That's what changed. Let's decode the report. The headlines was Delta's reported earnings swung from a loss of 44 cents a share to a profit of $2.44, a blowout quarter. What is the reality? On an adjusted basis, the way you actually compare an airline to itself, earnings are down from a year ago. That reported swing is mostly investment paper gains that have nothing to do with flying planes. And the verdict is a genuinely strong quarter, yes, hiding inside a misleading number. The business accelerated, of course, but the fuel just masked it. Let's start with that report number because it's a trap. On paper, GAAP, Delta went from a 44-cent loss in the March quarter to a $2.44 profit in the June quarter. That's look like a miracle turnaround. That swing is investment mark to market. The value of Delta's stake in other companies moving up and down on paper. In the March quarter, those stake lost about 550 million on paper. In the June quarter, they gained about 350 million. Add that up, and almost the entire turnaround is accounting noise. It has nothing to do with selling seats. So, throw the gap headline out and look at the adjusted numbers. The airline itself, that's where the real story lives, and it's good one. Adjusted revenue growth accelerated. In the March quarter, revenue was up 9.4% from a year earlier. In the June quarter, it grew 13.9%. That's acceleration at a time when a lot of people were worried the travel boom was cooling due to geopolitical tensions between Israel, US, and Iran. And it's broad. Premium cabin revenue went from up 14% to up 17%. Loyalty revenue went from up 13 to up 19. The check Delta gets from American Express for its co-brands cards grew to 16%. Even cargo jumped from up 9% to up 39. Here is the one that matters most. Though, because it's the part of the airline everyone had written off, the main cabin, the cheapest seats, for the first time since the end of 2024, main cabin unit revenue turned positive in the March quarter. And then it did it again in the June quarter, growing double digit. That's real headlines. Two quarters in a row. The low end of the plane is healing, not just front. So, if revenue is accelerating across the board, why are earning down year over year? Only one word, because of fuel. Look at the two quarters side by side. In the March quarter, fuel was up about 7% from a year earlier, a mild headwind. Adjusted earnings per share that quarter rose 44% from 45 cents to 64 cents. In the June quarter, fuel was up 75% and adjusted earnings per share fell 26% from $2.12 to $1.56. Same company, same accelerating demand, opposite earning outcomes. The only thing that really changed between those two quarters is the fuel comparison. That's the whole story. And even with that 75% fuel spike, Delta still cleared the bar it set for itself. Back in April, it guided the June quarter to earnings of a dollar to a dollar 50. It delivered a dollar 56. Above the high end, it guided operating margin to 6 to 8% and delivered 8.8. Part of that beat was demand lending at the high end, and part of it, honestly, was fuel coming in less brutal than feared Delta had assumed, about $4.50 a gallon, and it came in closer to 393. We will always tell you which is which. So why does this matter beyond one quarter? Because it tests a specific claim Delta has been making. The knock on airline was simple. They are leveraged bets on the price of jet fuel. Fuel goes up, profits vanish. What Delta is trying to prove is that it has built enough non ticket revenue, premium seats, the credit card economics, loyalty, aircraft maintenance for other airlines, that it can eat a 75% fuel increase and still make real money. This quarter, that claim held up. Delta made about $1.4 billion in adjusted pre tax profit while paying the highest fuel bill in its history. That's the entire thesis, stress tested in real time. But, and this is the honest part, it held up while earnings still fell year over year. Durability doesn't mean immunity. The fuel spike cost real money. Free cash flow is the tell here. It dropped to just $209 million dollars in the June quarter, down about 70% from a year ago. For a company this size, this is a thin. So the balance sheet is strong. Delta calls it the best in its history, and it just raised its dividend 15%. But the quarter was not a cash gusher. Now, here's why the setup matters more than the quarter. Delta's guidance for the September quarter assumes fuel drops to about $3.15 a gallon, down sharply from 393. If that happens, all of this accelerating revenue stops, getting eaten by fuel, and starts dropping to the bottom line. That's why Delta is guiding September operating margin back to 11 to 13%, double digit again, and affirming full year earning of 650 to 750 a share. So, the whole forward case rests on one variable finally turning from a headwind into a tailwind. The revenue engine is already running. The question is whether fuel gets out of its way. So, where does VYNG, wing, land? Our conviction score on Delta's durability thesis steps up from a 6.5 after the March quarter to a 7.5 after June, up a full point because Delta did the hard thing. It beat guidance against record fuel, accelerated its revenue, and affirmed the full year plan. The thesis got de risked, not higher than 7.5 though, because absolutely earnings are still down year over year. Free cash flow got thin, and that full year target leans on a fuel tailwind that hasn't actually arrived yet. Constructive, de-risked, not euphoric. And to be clear, this is an editorial conviction score. It is not a buy or sell recommendation. Three things we are watching into the September quarter. Number one, does fuel actually land near that 315 a gallon assumption? That single number is the difference between a 11% margin and a 13% margin. Number two, does the main cabin make it three quarters in a row of positive unit revenue? That's the durability tell on the demand story. Number three, does free cash flow recover? The first half brought in 1.4 billion against a full year target of 3 to 4 billion. The second half has to do the heavy lifting. Here is the bottom line on Delta. The headline said loss to blowout. The reality is an airline whose business is quietly accelerating, temporarily buried under the biggest fuel bill it's ever paid. We don't chase headlines. We explain what changed. The complete research report, every figure sourced straight from Delta's filings, available on vyng.io. I am Vikas. This has been what changed from VYNG, clarity, not clutter.